We expect 2022 to be a year of transitions. We see central banks taking measured steps toward rate hikes, inflation calming as supply disruptions settle, consumer demand replacing government stimulus, and the global economy adapting to the pandemic. Let's take a closer look at what all this means for returns and our portfolio positioning. We forecast a 9% equity return in the US and 8% in Europe, short of 2021's rally, but still respectable with support from slower but sturdy economic growth. We see growth in both of these regions at 4 to 5% as sufficient consumer and business spending overcomes lower government stimulus. Corporate earnings exceeded expectations in 2021, and we anticipate continued strength. We forecast emerging market returns to be comparable to the other regions, but with higher risk because of China's tighter regulations and slowing economy. In the fixed income market, we expect high yield to provide equity-like returns of 9% with less risk. This makes high yield our highest conviction overweight in our global policy portfolio, backed by anticipated strong corporate earnings and low default rates. We're also overweight natural resource stocks, which can protect against inflation. Demand for natural resources will remain strong as the economy continues to expand. Natural resources' attractive valuations, both relative to other equities and historical levels, give it room to run. As for the risks to our forecast, we're watching the potential for disruptive inflation leading to premature monetary policy tightening. There are signs of easing inflationary pressures and key bottlenecks, but strong housing and labor markets in the U.S. warrant consideration. We expect financial markets to continue to focus on an intermediate-term easing of pricing pressures as supply chain issues improve. Globally, pandemic concerns still linger, in particular with new variants, but we don't expect variants to derail economic growth unless they worsen mortality, vaccine effectiveness, or testing accuracy. We are overweight risk with a preference for developed market equities, high-yield bonds, and natural resources as we enter 2022. While the Federal Reserve and inflation have sparked uncertainty, we don't foresee significant economic disruption. Rather, we think strong corporate earnings, slowing but sturdy global growth, and low long-term interest rates will support our positioning.